All right, what is up, everybody? Tech Retirement Guru is back, y'all. All right. Listen, I've already gone over this on the Zoom whiteboard, but I don't like it too much. It's kind of blurry. I don't know. Wasn't that great. All right. But we're going to go over this again. All right. Make sure this really gets implanted in your brain. So, IBC, Infinite Banking Concept, right? With a life insurance company with a participating mutual fund, right? Meaning when you start one of these whole life policies, you have a percentage of ownership with that company and their profits. Kids can't talk, can't write, looking great. All right. All right, so we're gonna go over how this process works, right? This is a process. This is not a product. This is the process. If used correctly, will change your family's lives for generations. I promise you that. Right? All right. So we're kind of going to go around this board like Monopoly. That's where we start. We're going to start where we save our money first, right? So instead of putting it into a banking account like Bank of America, we're going to deposit $50,000 into this whole life policy. Okay? Now, at the point that we do this, we would already established over here in our opportunities what debt we're going to pay off first. Okay? So we'll go ahead and start with the car. Say the car was $40K at 8% and $700 a month. Okay? So, as a bank, what are we going to do? We're going to pull out a loan against ourselves. Loan at this current insurance company with a participating mutual fund is 5% and earning 5.3% in dividends. Right? So we've got some little bit of positive arbitrage there. Now, on the dividends, as I showed in the illustrations, are not guaranteed, but for over 120 years, this company has never once not paid a dividend. So pretty safe to say, we're gonna get a dividend. So we're gonna deposit $50,000 in this whole lot policy. $50,000 is gonna be our CD, or known as cash value, right? Now, we're gonna take out a loan against ourselves for $40,000. Okay? Now, that loan is gonna have 5% on it. We get paid back to the insurance company. But here's the big thing to understand with this. If we have $50,000 in Bank of America, we pulled out 40, we'd have 10 left, right? And for kickers, let's say that Bank of America was paying us 5.3% interest. Well, they're not going to pay us 5.3% on 50K, right? And all we got left is 10K. Well, it's not how that works with these policies, because they are NDR. It is non-direct recognition. Simply meaning they know that you've taken the loan, but they don't recognize the loan, allowing you to earn that dividend percentage, 5.3%, on the full 50K, your full amount of cash value, no matter what it is. 50K, 20K, 100K, a million. You pulled out 500,000, you're still getting dividends as if 1 million was still in there. Now, why is that as well, other than NDR, is because of the death benefit. These policies come with the death benefits, life insurance, right? So the CD, the cash value, is the collateral that allows you to pull out a portion of the death benefit to borrow against. Okay, so really you're borrowing against your death benefit and not the cash value. All right. Make some more sense there, right? If I could talk to that would be great. I don't know how much time I'm gonna do this video. I don't know. So we take the 40K. We've already established we're paying off the car. So let's do that. We pay off the car, 40K. We got rid of 8% right there. Got rid of $700 a month. What do we do next? Well, they don't start spending $700 on Lululemon and Gucci and whatever you're into. All right? No. You take that $700, redirect that payment into a separate bank account and back into the policy. Okay? Now, important thing to note here is that we also recaptured 8%. We put out a loan for 5%, which gives us a 3% spread on that. Now, like I said, like Monopoly, we just keep it going, come back around. You know, let's say, after a year, well, we just make it simple, right? Let's pretend like we didn't do that. Let's just say our cash value is $50,000. We haven't pulled out a loan yet. We got a credit card over here for $20,000 at 25% interest rate and $500 a month. Okay, what are we gonna do? We're gonna borrow against our death benefit again. Either cash value that's collateral. We're gonna take that 20K. We're gonna pay off this credit card to American Express. We're gonna recapture this 25% here in a minute. We'll take that $500, redirect that into our policy on top of whatever annual premium we're paying. Then, on top of that, we recaptured 25%, well, excuse me, 20%, right? 25% was the credit card APR, 25%. We recaptured their 20% spread. And then we just keep this going. You pay off a mortgage, your student loans, whatever kind of debt you got. You pay that all off, right? And then you move into investments, and your main focus would be the spread, right? So we don't need to worry about that. Let's say we have real estate, we pull out a loan against yourself for 5%. We knew that we were going to get 15% return over here, right? 15% minus a 5% loan. We just made a 10% spread on our money right there, right? And taking that cash flow and flowing it back into our policy. Okay? Now, how this sets up for generations, right? For one, not necessarily the limit on how many policies you can get, but yes, these things do. But it's going to be dependent on your net worth, your income, those two factors really. But assuming this person here just had one policy, right? Well, they paid off all their debt. They used the process correctly. They invested in assets. They're 80 years old now, we'll say. They invested in real estate. You know, they got 10 properties. They got business. They got 5 businesses. Whatever. So they got all these assets they built up over the years and cash flow. Okay? So they have that whenever they pass away to the beneficiary. But they're also going to have, let's say, at 80, this cash value is $5 million. say his death benefit is $8 million. Now, say that he pulled out all $5 million at 80, right? Week, month, 2 months later, he dies. Okay? So, the insurance company is going to take the $8 million minus the 5, and it's going to pay out a $3 million tax-free death benefit to the beneficiary. Now, if he didn't take out the 5, beneficiary would get all $8 million tax-free. You took out 2, I mean, you can keep playing with the numbers. But in this instance, let's say that. So the beneficiary is going to get $3 million in tax-free death benefit. They're going to get all of the cash flow and the assets that he built up over the years, right? If you have multiple policies, you're going to get more than one death benefit, tax-free, right? And more than likely, this person had already taught them how to use this process correctly. And who knows how old this person is. Let's say they're 40 years old, been using this for a while. They got 5 policies, right? They've been building up all their assets over the years and will continue to. And they have all these death benefits to be passed on to their children, and then to their grandchildren and their children, and the list just goes on. So, I mean, you build up all these assets, all these cash flows, you get all this death benefit. I mean, why do you think the Rockefellers have so much money? They've been using this for a long time. But you can go ahead and do your research on that. Banks have been using this for quite some time. Don't want to speak out of turn. I believe whole life was introduced in 1840. Pretty sure that's correct. Right before 1860, right? Which we know was the Civil War. This is how long this stuff has been around. And banks have been using this for a long time. It's called BOLI, bank-owned life insurance. You can look that up. Billions and billions of dollars invested in this stuff. Now, on paper, it just says they're invested in life insurance, and people like to say, oh, they're invested in IULs too. Maybe, but highly doubtful. Whole life has been around since 1840, and IULs have been around since 1997. Wonder what they've been using. But I think that about covers it for today. If you guys have any more questions, you want to do one-on-one on the whiteboard, then hop over to illustration, figure out your financial needs, your situation, what you're looking to do. You can go to my link tree on any of my socials. Go to my website, www.cgagency.net. Right, you can book an appointment on there for whole life, IULs, if you want to talk about those, annuities, deferred and immediate for safe growth, and for immediate income, that can be lifetime income, that can never be outlived, can still grow in value, and can be passed on to your spouse. What else? Health coverage, affordable health coverage, especially if you're healthy. If you're not so healthy, not so much. But we can explore other avenues with that. Supplemental benefits like accident, cancer, hospital plans, ERC tax credit program for businesses. So if you're open from 2020, 2021, you can get a tax credit straight from the IRS up to $26,000 per employee. Okay. But the next video I'll probably be making is why an IUL cannot, and not financial advice, but should not, in my opinion, be used as an infinite banking concept or system or process at all. Okay? Don't do it. Right? Financial advice. Well, again, Jack Retirement Guru. If you like this content, give me a like, give me a subscribe, show it to your friends. They're interested in becoming their own bank, and we'll help them get set up. Much love to y'all. Have a good day. Have a good night. See you later.